Welcome to the deep dive video update. And I always want to explain this if you're new to watching the videos that I post. Every week, I do a number of different videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. After those videos, I go through and I look at the charts and I say, okay, which charts didn't I really talk about all that much? And I put them into this video. And there's also some additional charts that are unique only to this video because sometimes by looking a little deeper, that's why I came up with the name Deep Dive, sometimes we can still get some insight and some clues as to what's happening in the market. This is being prepared for Monday, October 14th. Before I get into the video, I do have a thing called the SPX Investing Program. It's up, it's going, and it's free until the end of 2024. If you want to learn more about that, here's an email address where you can contact me. There's also a link that'll take you to the website, as well as another link that'll take you to a video that talks more about the program. And again, if you have any questions, don't hesitate to ask me. The daily video is the real foundation of what I do. You can see right here, the deep dive video. This is just one of many videos I do over the weekend, and they're all meant to tie into the daily video. And I know my videos are longer. I know I go through a lot of different things, but to really get insight into what's happening in the market, it requires that amount of focus and looking at different things. It's not as easy as just looking at one or two or three charts. You can make it that easy, but then you might be missing something. And I found over the years is what you don't know that comes in from left field and catches you by surprise. That is what really can impact success and turn it into failure. Okay, so the first chart we look at, I only show in this video. What you see on here is the VIX, but the VIX is invisible. Over top of that, I have a 50-period exponential moving average going back to 2004. This just gives us a big picture look at what is the general range for the VIX over a period of time. When the market's going down, the VIX goes up. When the market's going up, the VIX goes down. And even though we're coming back up now, and we're getting some interesting readings from the VIX, if you want to find out what those are, please watch the daily video because I've been watching that for about a week now, and it could be something negative for the market, but the market's not really paying attention to that. But we'll just keep watching it and see if it does turn into anything negative. But right now, we are going up, but we've come down into a lower range as the stock market has been going up. We also want to see how fast is the VIX moving. And I put an RSI based on 9 periods on the VIX here. And really, I only show this chart when we're getting extreme positive or negative readings. We had one there for a while, but it only lasted a day or so. Now we're getting more down into the neutral area, so I haven't been showing this chart. And then we look at the VIX, and then there's another indicator type thing that measures the volatility of the VIX or the VVIX, and we do a ratio between them. We're not really getting an awful lot of insight now, other than this is going up as the VIX has been going up lately, and that tends to be more negative for stocks, but we just set an all-time high with the S&P. So we're seeing some strange things with the VIX right now that we're seeing in other charts, but we're not really getting any additional insight from this chart other than what we're already seeing elsewhere. And then we look at the volatility of stocks as measured by the VIX, and then the volatility of bonds is measured by the MOVE index. And both bonds have been under pressure lately. Interest rates have been going back up. And even though the stock market has been going up, or the S&P 500 is going up and setting a new all-time high, the VIX is still quite high too. And that's why we're seeing this red line, the moving average, going up lately. We keep an eye on the Ulcer Index, which is another sentiment gauge to tell us, is there a lot of fear in the market? Because when this goes up, the ulcer, people start to worry about things. Right now, we're underneath the moving average. It's not really giving us a high reading like what we're seeing with the VIX itself. And then we are 20.68% above the previous all-time high that was set in early January 2022, and that's as of Friday's close. So that's a pretty significant move. after we went through 2022. All right, then stockcharts.com has this thing called technical alerts. I go through them in each daily video, but what I show you here, these are all of the alerts that were triggered for the whole week. And it's not just the S&P, even though the S&P shows up here. We went below 5,700, then we got back above 5,700. Then near the end of the week, we got above 5,800, and that's when we set the new all-time high. But typically, how I look at this chart is if there's a lot of red, we're going down. If there's a lot of blue or green, we're typically going up at that point. And Thursday and Friday were more positive for the market. And so we saw a lot of blue or green going up here. The one thing that we're a little bit concerned about is discretionary. It had a BPI across below 70. That means it's coming down after having been stronger. We want discretionary to do quite well because that's kind of like a growth area where you want to buy low and sell high. Okay, then stockcharts.com has this other thing, and you can do this with a stock, with a mutual fund. I think you can with a mutual fund, with a sector, with an index. I use this with indexes, and I look at 5 main indexes to see which index is performing the best. And they rank them on a scale of 0 to 100. The higher the score, the better looking that particular index. Coming in first place is the S&P 500. It's actually been holding up quite well. It did set an all-time high on Friday, and it's been outperforming the NASDAQ 100, which is usually the high flyer that people really like to get into. Well, that's been lagging. It did really well up until about the middle of July, and it's doing okay. It's not falling apart, but it's not really screaming to the upside like it was before. Well, there are 503 stocks in the S&P 500, and those stocks have been doing better than the 100 that are in the NASDAQ 100. So we're coming in first place with a score of 84.1. Now, this could look better. I mean, when something is really positive, we get up into the 90s, but still, 84 is a respectable score. In second place, also setting a new all-time high in Friday's session was the Dow, and this is the Diamonds, which is the ETF attached to the Dow, coming in at 80.7. Then we have the QQQs coming in at 80, still looking okay, but not really leading the market higher like it was earlier in the year. And we're seeing this kind of a shift going on in the market. And I'll go through some of that as I get to some other charts. Then we have the small caps coming in at 66.5, and they had a good day on Friday, but they really haven't broken out of their range that they've been in 2024, especially over the last few months. They've been more range bound. They go to the top of the range and then fall back. Well, the hope is that at some point they may actually break out of the range and then setting a new high during the week, but coming in last place are the mid caps at 63.1. Then we look at a short-term chart. This is a rainbow chart where I plot a 10-period moving average all the way up to a 50-period moving average, and I change the color so it looks kind of cool. But when price is above the lines and all the lines are going up, that just confirms to us that the short-term trend is still positive. Then this is kind of a variation of that. This is a 20-period moving average of the open, high, low, and close. That creates its own little mini rainbow here. And we're above all the lines and the lines are going up. This also confirms that the short-term trend is still positive. Now, the reason I'm not showing this in the videos is usually when we're going up and then we fall back, one of these lines may act as support. And when we're below it and we're bouncing back up, one of these lines may act as resistance, and we're well above the rainbow right now, so I haven't been showing it. Now, I show a number of different studies of those stocks inside of the S&P 500, and are they above their 20-period, 50-period, 100-period, or 200-period moving averages? Because that can give us an idea of the internal strength of the S&P. Well, connected to the 20-period moving average study is this other study here, and we're below this 70 level now. When we get above that, that just means that there's good, solid upward momentum in the short term, and we're not really getting anything at this point. And we look for divergences here, either positive or negative. You can see back here where we had a higher reading here. Well, we ended up setting a lower low with the S&P at that point. But then later on, we had a real extreme negative reading and then shot up quickly. And then what the S&P did after that. Well, we're waiting for something like that to happen. We haven't got to a really low reading, nor have we been at a very high reading for the last number of days. So there's been no need to show this chart. Intermediate term, another rainbow, which I have the short-term rainbow here again, but just, I guess, take my word for it. The intermediate term trend is still positive. Then I haven't even been showing the 50 period moving average in the videos because we're still above the 20 period moving average. And this is still looking quite healthy. And with the blue line, this is the exponential moving average above the red line, which is a simple moving average. And that just means there's good momentum when the blue line's above the red line. Then we look at the 100 period moving average, which I haven't been showing that either because we're far away from it now. And we're still looking pretty solid that way. And then standard deviation. I only show this chart when we get above the moving average. Now, this doesn't measure direction. This just measures speed, whether we're going up or down. And we spent a number of days just chopping sideways. And it looks like we were going to break lower. Then we went right back up into the range. And then finally, we were able to break out above this and set a new all-time high. And the standard deviation goes back over the last 10 trading sessions. And it's picking up a little bit, but it's still below the moving average. So I haven't been showing this chart. The mass index is not generating a signal right now, so I haven't been showing that. And the Pring bottom fisher, which we've been going up, so there's really been no need to consult with this chart. And then we want to keep an eye on the distance away from the 200 period simple moving average. You notice earlier on in 2024, we got about 15% above, and then we saw a pullback. Then over the summer, we got about 15% above, and then a pullback. Well, right now, we're a little bit over 10% away from the 200-day simple moving average. Unless we really continue to go up and we get about 15% above that moving average, there's been no need to show this chart. Then we just keep a measure here. Going back to 2023, the low that was set in October, a little over a year ago, we've now climbed almost 30% from that low. And then this is what I'm talking about. When we got up here, we were kind of far away from the 200-day moving average, and then we pulled back, and we almost came down about 10%. 10% is the definition of a correction. When we got down close to that 10% level, this is when the smart money started coming in and buying and pushed the S&P back up. Then we use the Connors RSI, which is very similar to a regular RSI. We just look for extreme positive or negative readings. We're not getting one of those right now. And then anchored moving averages. This is something that I find more helpful when we're actually declining. We're above all the anchored moving averages here that I have plotted, so there's been no need to show this chart. And then the CMB composite, I use this like an oscillator. I had been showing it quite a while in September. We were getting an extreme positive reading, but since then we've dropped back down into the more neutral area. So I haven't been showing this chart. And then we look at Bollinger Bands. And as I mentioned quite often, there's books written about the different ways you can use Bollinger Bands. This is just one of those ways. It's called the percent B indicator. And it just measures when we close above or below the upper or lower Bollinger Band. We're close and we're above the midpoint, so we're positive, but we didn't close outside of that Bollinger Band. So I only show this when we're getting an extreme positive or negative reading. No new X's or O's were drawn, even though we set an all-time high on Friday. This chart is still looking quite positive. We're working off of a double top breakout that was generated on September 19th, which is kind of interesting. And I mentioned this last time. We're working on a triple top breakout that was generated on the 16th of September on the weekly chart. So double top, triple top, take your pick. But on both time frames, the daily chart, which is what you see here, and the weekly chart are both looking quite positive now. Then we want to keep an eye on the S&P 100 and see, is it really performing much different than the S&P 500? And not very much. It did set a new all-time high itself on Friday, as did the S&P 500. And then a long-term rainbow here, where we're still looking good. We're above all of the plotted moving averages here, going from 50 periods up to 250 periods. And then this is a long-term oscillator. We're still positive. We crossed over positive back in 2023, and we've been above that line ever since, even though there have been some periods of weakness along the way. And then we look at a weekly chart of the S&P on top and a weekly chart of the German DAX, which is the biggest market in the EU. And the correlation is getting a little bit stronger. We're actually seeing a weakening of the correlation, but that's why we keep an eye on what's going on in Europe, because sometimes that can give us some clues as to what may happen in the US and vice versa. What happens in the US may have an impact on what happens in Europe. Then some support levels, and I had to readjust these just because we set a new all-time high on Friday. This is pretty much irrelevant unless we start to decline and come down to one of these Fibonacci retracement levels. Let's see. Yeah, that was the only chart there. And then the QQQs, I was showing this for a while because we were dropping below the moving averages. Well, I stopped showing it when we crossed back above the moving averages, and now the blue line is above the red line, and we're above the 200-day moving average as well. And where we have the VIX that measures the volatility of the S&P, the VIXN measures the volatility of the NASDAQ 100. I don't focus on this one as much because I mainly focus on the S&P 500. And we look at a ratio between the S&P and the Qs, which is the NASDAQ 100, and the diamonds, which is the Dow. And even though the relationship between the top chart and the middle chart is weakening a bit, they're still having a pretty strong tendency to go in the same direction, either up or down at the same time. And then the transports, which continue to be disappointing, they've been pretty much chopping sideways for all of 2024. They had a pretty good day on Friday, but they're just getting near the top end of the range that they've been in. That's the red area where the Dow is now setting a new all-time high. So that is a Dow theory non-confirmation, but we've seen that many times in 2024. Banks, they had earnings come out on Friday. So the bank ETF did really well, up almost 3%. Not quite ready to set a new high yet, but still looking solid nonetheless. And then we want to keep an eye on the regional banks like Republic Bank, Silicon Valley Bank, banks that were having some problems. That's what sent this ratio really going down compared to the financial sector. And we're still hanging on, not really outperforming. We're in an uptrend with this ratio, but we're not really breaking down either. Then this is a couple of charts that I showed just for informational purposes. This is the rate of change from Friday's close going back 250 periods, and we're looking pretty solid here longer term. We're also above this blue line, which sometimes has been a concern to us, but we're getting a little further above it right now as we're seeing longer positive momentum. Keep an eye on bonds. And now this is something strange because we could be seeing a change in context here. Now, back in 2021 and into 2022, we saw this ratio really going up because inflation was going up, interest rates were going up, and that was causing this ratio to go up. And then we started to come down. Well, now we started to go back up when they were worried about inflation. Then we came back down. Now this is starting to go back up, even though we're still in a downtrend right here. This is why I say we might be changing some characteristics in the market right now of the relationship between stocks and bonds. And right now, anyway, now things could always change down the road. We can only go with what we see right now, but we have been seeing interest rates going back up and stocks going up. And maybe in this kind of an environment where inflation seems to be under control, the Fed is coming in and actually cutting rates, you can see this ratio going up and it's still positive for stocks. We want to know the context of why something is happening. And it can take a while for this to play out, but this is what it's looking like right now, is that this is going up. We shouldn't necessarily freak out about that. But before, when we saw this going up, that was a big concern to us. We just want to keep an eye on what's going on and see if we can figure out the context. Then we look at the long-term bond ETF, that's in blue, which has been going down, and the S&P, which has been going up. And you can see that the longer-term correlation is starting to weaken as they're going in opposite directions. And the short-term correlation is also quite weak right now as they're going in opposite directions there as well. And we do the same thing. We look at the Qs compared to the long-term bond. They're more neutral right now with their longer-term correlation. As the Qs, even though they're not setting new all-time highs, they're still holding up quite well. And the price of the long-term bond ETF has been going down. That's why we're seeing this correlation weaken. Then we look at the 10-year yield in the US, and we subtract the German 10-year yield. And because US rates are higher, that gives us a positive answer here. And believe it or not, we can compare it to the US dollar index. And we can see there's a pretty strong correlation here between the two. So this is just telling us that interest rates going back up could actually be benefiting the dollar, because the dollar, even though it's in a downtrend, has been bouncing back up recently as interest rates have been going back up. We want to keep an eye on the 2-year Treasury yield. We're wondering if the context is changing here as well. You can see for quite a while, when we would top out and go down, that often gave short to intermediate term support to the S&P. Well, we topped out and are coming down. And yeah, the S&P is going up, but now we're starting to go back up with the 2-year yield, but it's not really having much of an impact on the S&P. So we're just keeping an eye on this one also. And then I talk about this in every daily video, but I don't show the chart because we went back to being normal or uninverted here when we look at the 10 to the 2-year yield curve. And unless we drop back below zero and go inverted again, I've just been mentioning this rather than showing the chart. And we're showing a little bit of an improvement here, but we're still inverted with the 10 to the 3-month yield curve. It was the last one to go inverted, and it'll probably be the last one to go uninverted if things still remain positive with the US economy. Then we have these things called possible positive scenarios. I use a lot of those charts in the daily videos. What I show here are the charts that I don't use. And this is the percent of stocks in the S&P above their 200-day simple moving average. I use this particular chart like an oscillator. When we get extreme positive or negative, we're not. So I haven't been showing it for that reason. But we're still positive since we're above 50. Then we look at those stocks in the S&P above their 50-day moving average. Also use this like an oscillator, or not extreme, but we are above 50. And then just to get a little bit more exposure here, we look at the mid caps, which are not extreme right now, but still above 50, and the small caps, which are showing some improvement here, but not necessarily extreme positive right now. And they're also above 50. So thank you. I hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.